Awesome. All right. Well, let's kick off. Hello everyone. Thanks so much for joining us on the topic of the Australian property and tax. So, Australian property, it's always a hot topic amongst the Australian expat communities, particularly in the Asian region where I'm based. So. I'm going to be your host today. So Stephen Lee from Odin Mortgage, where I have the pleasure of leading our mortgage services for the firm. And then I have my colleague here, Pao, who's leading our tax arm for the Odin business. And then we have a special guest today, Richie from Milk Chocolate Property, leading buyers agents in Sydney, helping the expat communities buying family home and investment properties. So in terms of how we're going to run the show today, of course that as I mentioned, the Australian property is a hot topic amongst the expat communities, but particularly this time of the year. So we wanted to bring the experts together to take you through what's happening in the market and share some tips and learnings so that we can better help you better manage your plan to get into the property market, whether now or in future. So we'll go around the room, and then each panel would go through their respective topics. And then we had quite a few questions that have come through the registration, and also the live Q&A will be open for you to ask any questions. And we'll make sure that we allow some time at the end to address as many questions as we could. So on that note, first up, I'd love to invite Richie to take us through who's Milk Chocolate and what's happening in the property market, and take us through their awesome digital platform. Over to you, Richie.
Awesome. Thanks, Steve. Thanks for the introduction, and welcome everybody. Thanks for joining us today. As Steve mentioned, I'm Richie Ragel, the co-founder of Milk Chocolate Property. So today we're going to talk about how Milk Chocolate supports Australian expats purchasing family homes and investment properties back home in Australia. We're going to do a bit of a current around the grounds on the Australian property market. So getting in deep with regards to what we're seeing on the ground. It's a report written by our economist, Kevin. So that's going to be really interesting. And also a little bit about our digital platform that takes away the complexity of buying property from afar. And also, guys, just a standard disclaimer that any advice today is in general in nature, and always just consult your professional services provider before making any decisions. So for those who are not aware of Milk Chocolate, and what we do, so essentially we offer a complete service encompassing research, planning, buying, building, and management. Milk Chocolate takes care of every aspect of your property journey on your behalf. We're nationally licensed and purchase properties in all states and territories, excluding the Northern Territory. A little bit about myself. So I've been purchasing, renovating, and selling property since 2006. So coming up to 2 decades now. So co-founder of Milk Chocolate. My role in the business is that I oversee the data and analytics team, the purchasing and construction teams. I've also personally assisted more than 350 clients to create, implement, and execute their property goals. Since 2016, I've also personally helped about 120 of our clients purchase properties. So have been doing this for a little while now. So hopefully it would sound like I know what I'm talking about, because we've been doing it since 2006, but assisting our clients since 2016. A little bit about the team before we get into it. So it's not just me. My co-founder is Michael Cleary as well, but we've also assembled a team of world-class subject matter experts that span across all major aspects of the property journey. So as you can see there's 4 pillars, and that's 4 pillars to our business. So data and analytics and economics, purchasing and due diligence, design and project management, and property management. So that team is composed of economists, valuers, qualified property investment advisors, data scientists, real estate agents, project managers, interior designers, property managers, to name a few. So across those verticals, we assist our clients to execute across that whole property journey. The primary focus of the business is that we purchase properties, but that's assisted by those additional pillars that execute that journey from start to finish. We work with Aussie expats looking to invest or buy properties back home in Australia. So just a little bit about the results before we jump into what's happening in the Australian property market. So the reason why we wanted to put this here is because we're actually really proud of the results since inception in 2016. So on average, our clients have achieved about 13.63% growth year on year since 2016, with an average yield about 3.39%. So that goes back to the subject matter expertise and having those experts in data, economics, but also in real estate, construction and property management to help us achieve those results for our clients. And what's really important to understand is that is over a period of time where we've seen multiple property cycles. So there's been plenty of ups and downs since that particular period in time, but it's really important to understand the fundamentals of the real estate property market, but also understanding what the data and analytics are telling us and where we should be purchasing in each of those particular markets at what particular point in time as well. So I'm assuming this is what a lot of you are here to hear is what's happening in the Australian property market trends. So our senior economist, who's Dr. Kevin Hong, put together these amazing insights. So Kevin has a PhD in economics, econometrics and statistics, and is responsible for our economic and data expertise. So what we're going to do today, guys, is we're firstly going to take a look around the grounds and understand what's happening in the Aussie property market. We'll then focus on the drivers that we should be monitoring moving forward, followed by a high-level assessment of the current property cycle and our thoughts on each of those particular markets as well. So jumping straight into it. So the current upswing in housing values continues to show strength. So values increased by 0.4% in August 2024, and marking a 20th consecutive month of combined growth since January 2023. So we're on a significant period of upswing still at this particular point in time. However, performance varies across each of those particular cities. So Perth, Adelaide and Brisbane, as you can see, are the top performers with year-on-year growth rates of 21%, 12% and 11% respectively over the past 12 months. In contrast, growth has been slower in Hobart at -2%, Melbourne at -3.2%, and Canberra at -3.3%, and Darwin, of course, at -4.3%. So that's generally driven by weaker market confidence and an influx of brand new housing supply. And that's particularly in the Melbourne market at this particular point in time. So despite these differences, it's essential to keep a broader view about the fundamentals in each capital city. So strong performance in some cities may not last in coming years, while underperforming cities could offer better opportunities to enter into the market and benefit from future growth phases. So we're currently moving into a buyer's market with vendor discounting remaining steady at -3.7%, reflecting market conditions and a vendor's requirement to negotiate to secure a deal. So that's really important to note and understand. So important to understand what the data is telling us, but what we're seeing on the ground is reflected in that particular figure as well, is that now vendors' expectations need to realign with where buyers are at, because buyers are now showing a little bit more patience and happy to walk away from deals if the vendors aren't willing to come down in their price points. So we're certainly starting to see that shift, which is great news from a buying perspective. From a new listings perspective, so new listings totaled about 42,000, so that's 2.1% higher than the same time last year and 8.2% above the historic 5-year average. And it's the highest level of new listings in the first month of spring since 2021. So obviously that's correlating with supply. So increase in supply may also see some of those markets starting to cool, in particular those markets that have performed well over the last 3 to 4 years. So we've seen total listings rising to about 145,000 in the 4 weeks to the 6th of October 2024. So Sydney at 3.7%, Brisbane 12.1% and Perth at 9.4% have all seen stronger flow of new listings over the 4 weeks to the 6th of October compared to the same time last year. Total listings in Brisbane are now 4.2% higher than this time last year, while advertised supply in Sydney and Melbourne is 6.9% and 7.9% higher respectively. So that's but also this is dependent on where you are looking and which particular markets that you're focusing on. In some of the markets that we're currently buying in North Brisbane and some of those sub-regional markets, supply is still pretty tight, especially when you're looking at the quality of the supply that's coming onto the market. So it's important to note supply may be increasing, but it's the quality of that stock that's coming onto the market. We're still dismissing a lot of those properties because they're not meeting the real estate fundamentals that we set as buyers agents to purchase great investment properties for our clients. From a rental perspective, national rent values increased by 7.8% in 12 months leading up to July 2024. So that's roughly double the decade-long average trend of 3%. So I'm sure you're all aware of that, but rents have increased significantly. That's due to the population growth in all major capital cities. This surge is occurring amidst supply constraints and rapid population growth, although the rental market has shown signs of easing in recent months and vacancy rates remain tight across the country. So given current challenges in the construction sector, such as rising costs and labour shortages, expected to take years for the rental market to return to that normal vacancy rate of 2 to 3%. And it certainly feels like it's been a period of time now since we have seen vacancy rates sit at that 2 to 3% value. It was only about 12 to 18 months ago where most markets are sitting below 1%. So we're starting to see that loosen, but it's still well below what we've seen historically. During this adjustment period, low vacancy rates and high rental yields are likely to continue, driving property prices upwards in 2024 and 2025 beyond. And it's also going to see a lot more appetite from investors as well, who are still chasing those high rents and obviously accompanied by those higher yields as well. So moving on to market drivers and what to monitor moving forward. So really, really important to understand what are the major influences that could affect pricing both negatively and positively. And Dr. Kevin has identified the following key drivers to monitor moving forward, confirming that these have the strongest correlation to positive and negative market movements over the next few years. So starting with population growth, so Australia's long-term average growth rate was 1.3%, but it surged to 2% in the past couple of years. That's compared to 0.3% in European countries, 0.6% in the US, and 0.6% across the OECD countries. High population growth places significant pressure on housing and infrastructure, pushing up price increases in the major capital cities across the country. And a major component of this population increase has been net overseas migration, which rose from a net inflow of 69,000 people in the 1990s to 200,000 in the 2000s and surged to 450,000 in 2022 and 2023. So it just shows you the significant growth that we're seeing here in Australia. Looking ahead, our projections indicate that the Australian population will grow by approximately 1.5 million people, which is actually the equivalent to the size of Adelaide, and that's within the next 3 years. So there's still a significant amount of growth driven by population coming to Australia. All of those people are going to need places to live, either from renting or from a purchasing perspective. So it's easy to see and understand why we think the market's still going to show some strong demand, which is going to keep price appreciations positive over the next couple of years across the major capital cities. Housing supply, so dwelling approvals and dwelling commencement. So given the robust housing demand and accumulated unmet need over many years, we're focused on housing supply, which is determined by approvals and commencements. So two different things here. So firstly, when we're looking at approvals, the ABS data release shows that 160,000 dwellings were approved in the 12 months leading up to June 2024, which is a significant drop from the peak of 230,000 dwellings approvals in 2018. So lower approval rates will lead to fewer commencements and eventually completions in the medium term, contributing to tight supply, especially in major capital cities with significant sustained population growth. So even if you combine those two things, when you're looking at population growth and the lack of approvals, you can see the stress that's going to continue to apply to this particular marketplace. Building commencements. So according to the latest ABS data, 160,000 dwellings were commenced in the 12 months leading up to March 2024, a decrease of 10% compared to the same period the previous year and about 20% below the long-term average of approximately 200,000 dwellings per year. So it represents the lowest figure since 2013. And that's coinciding with the cost of labour, cost of materials as well. And so this is something significantly that we just need to be aware of and monitor that. Obviously, we are starting to see governments, a lot of stimulus packages relating to releasing of new greenfield estates and incentivising builders to construct and build. And also, hopefully, we'll start to see some correlation back to council approvals and some, I suppose, state and federal government coming into those conversations to help push along approvals and commencements so we can get more buildings and housing built and developed for that growing population that we're going to see across the nation. When we're looking at inflation, the Reserve Bank of Australia aims to maintain inflation with its target range of 2 to 3%. So I'm sure you're all aware of that. We've been talking about it for a little while now. We know that ensures a stable macroeconomic conditions, full employment, balanced economy. Inflation has significantly declined from its peak. It's about 7.8% in December 2022. The rise in interest rates has played a key role, as we know, in cooling the economy by bringing aggregate demand and supply closer to equilibrium. Inflation has been trending downward, reaching approximately 3.5% over the 12 months leading up to July 2024. So getting closer to that point where we're going to see a level of comfort between that 2 to 3%. I'm sure the guys will talk a little bit more about this in more detail, in particular to interest rates and what we expect to see in the next 12 months from that perspective. Lending conditions, so housing loan commitments are a key driver for housing prices with an upward trend in these commitments, closely linked to increased buyer activity and rising property values. So recent data from the ABS leading indicators released on the 8th of July shows a consistent upward trend in total housing loan commitments, which grew from 22.8 billion in February 2023 to 29.5 billion in June 2024. So it's a significant upswing in that respect. Investors, as we know, are crucial to the housing market, and this rise in investor loan commitments indicates growing confidence in the property market's prospects. As investors typically impact market dynamics, their increased participation often leads to higher market activity, which leads to rising property prices. So nationally, the share of investor loan commitments has steadily increased over the past 16 months, accounting for about 38.6% of new mortgages as of September 2024, and that's the highest since 2017. So a couple of key things there that we're pointing out, which are all talking towards a positive appreciation in prices over the next at least 12 to 24 months. Finally, interest rates, which I know the guys will talk about. The current interest rates, the cash rate sits at 4.35%, and that's unchanged since November 2023. So we're coming up to nearly 12 months of those rates remaining on hold. The prospect of future interest rate cuts hinges largely on the inflation trend over the coming months. Major banks, which I'm sure the guys might talk to, which monitor real-time spending patterns of consumers and businesses, have begun reducing fixed rate mortgage rates, and implications of potential rate cuts are going to be significant. So I'm sure what's going to happen in the next 6 to 12 months. And I know the guys will talk about this, but they're starting to see some of those indicators that it might lead towards an interest rate drop in 2025, which we know is going to provide a lot of confidence back into that property market, especially again with investors. So there are some of the market drivers to monitor moving forward. When we're looking at the future forecasts, sorry, I've just jumped ahead. So property cycle duration analysis is what I wanted to talk about. And we'll share this with you guys. I appreciate there's a fair bit of information on this particular slide and some of the other slides as well, so you can take a deeper dive into it once we share it with you. But a couple of highlights that we just wanted to point out in this is that Sydney is on par now with its average growth cycle, which implies that we expect to see slower growth rates. However, investors are still going to be looking for value in this particular market and target affordable segments of the market where prices are sub 1.5 mil, such as the south and northwest growth regions where large infrastructure projects are being implemented. What we can also see is Melbourne's recent declines are in line with historical down cycles, indicating that an imminent growth period is upon us. And sort of what we know as well from Melbourne's recent declines is the fact that it was probably more induced by those forced lockdowns, 14 of which were in 2020 and 2021, which put a significant stop on that particular market for many growth. And what we did see was that, some of those markets, capital cities around Australia since 2021 grew by about 50 to 60%. Melbourne was at about 15 to 16%. So a significant effect on that particular market. We also saw a lot of people moving interstate, in particular to southeast Queensland and further north. And so we'll likely see some of those prices starting to appreciate in Melbourne's capital city within the next 12 to 24 months, based on what we're probably seeing at this stage is in terms of affordability in comparison to some of the other capital cities across Australia. We can also see that Brisbane still has some room to move, while Perth and Adelaide markets are currently outperforming the historical growth cycles. It's likely due, though, to the affordable nature in comparison to the other capital cities, which comes also from a low cost base, which is accentuating a longer growth run as investors continue to see value in those particular markets. And also yields are playing a factor in those particular markets as well. And the other key market to monitor is Canberra, where the city is projected to move to a recovering and rising phase after recent sluggish periods. So that's a couple of key things to point out in that particular slide. Again, looking at future forecasts across those major capital cities, and we'll talk a little bit about regional markets as well. But when we're looking at each of those capital cities, when we're starting with Sydney, it's the most populous city in Australia. As we know, the population of 5.4 million, strong growth rate of 2.8% from a population perspective. City boasts a diverse and high-performing economy, and there are no signs of oversupply with a stable housing supply of 30,000 dwellings. However, Sydney's medium house price is among the highest in the country. Well, it is at 1.35, which is 550,000 more than Melbourne's medium house price at this particular point in time. Given these factors, we anticipate that house prices in Sydney will continue to rise due to strong demand, though slower than in recent years, due to affordability constraints, more affordable segments in the outer rings, which I just touched on, such as the southwest and northwest regions with good connectivity to major CBDs, such as Sydney and Parramatta, will likely see strong performance. At the same time, prices in premium areas are predicted to increase at slower rates moving forward. It's also important to point out that Sydney is generally an owner-occupier-led market. And what we mean by that is you've generally got buyers in that market who are primarily focused on purchasing their family home as opposed to an investment property. Therefore, they're paying a little bit more of an emotional premium to acquire that particular asset for their family home and their principal place of residence. That's generally why you see that particular market growing at those particular strengths, and also why that median price is so high, correlating with obviously the economy and work opportunities in this particular city. But we'll definitely see the pace of growth, which we are already seeing at this particular point in time, continue to slow down. But we do believe it will still increase, although at a slower rate. Now, Melbourne, as I touched on, Melbourne house prices have been experiencing negative growth rates since December 2022, although there have been signs of recovery in recent months. House prices in other capital cities have surged 50 to 60%, while Melbourne has lagged behind around 15%. So the price gap between Sydney and Melbourne is now at its widest in many years. So as I touched on, 1.35 in Sydney compared to Melbourne's 810. However, Melbourne's large population, strong growth rate, diverse economy, and under-trended supply are expected to drive prices up in 2024 and 2025 and beyond. Additionally, house prices in second-tier cities like Adelaide and Perth are catching up to Melbourne, and Brisbane has recently overtaken Melbourne. This highlights the good value of Melbourne's property prices. We believe that Melbourne's house prices will move into a new growth cycle with stronger growth expected in 12 to 18 months. Brisbane, over the past years, Brisbane has been a favourite destination among investors, with house prices increasing by circa 50% since 2021, 2022. This surge can be attributed in part to the city's affordable prices and attractive rental yields, which have drawn in many investors seeking to navigate high interest rates. Despite the significant price increase, Brisbane remains relatively affordable compared to Sydney, and the city's strong fundamentals, including large and growing population, diverse economy. Also, the major infrastructure projects in preparation for the Olympics further support its housing market. And additionally, a severe supply shortage. Current listings are about 50% lower than pre-2020 levels. But as we touched on, we're starting to see some of that supply increasing in more recent months. We do forecast further growth from Brisbane in the next 12 months before a level of stabilised growth thereafter as more supply comes on the market and affordability becomes a more pressing issue in the coming years for this city. We're also buoyant on some of those regions, sub-regions just outside of the Brisbane CBD that are still within a commutable distance as well, when you're looking and taking into that consideration the ripple effects of price appreciation in the major CBD. Adelaide, once considered the sleeping city, Adelaide has certainly emerged as one of the country's hotspots, with house prices increasing by 60% from 2021. Adelaide's transformed a more diverse economy, driven by sectors such as high technology, shipbuilding, significant infrastructure projects, such as that north-south corridor, have also enhanced its appeal as well. So additionally, Adelaide offers rental yields that can be up to twice as high as those in Sydney and Melbourne, and a severe undersupply with only 7,500 current listings compared to 17,000 pre-2020 has also contributed to the city's strong price growth in 2024 and 2025 and beyond. We're certainly anticipating similar conditions of growth and stability in this market like we do in Brisbane. Moving on to Perth, the economy now is more diverse, although still reliant on the mining sector as its primary economy. It's before the global financial crisis, it was certainly dominated by the mining economy, which had some key risks for us when a city is driven or a market is driven by one key economic driver. But population of 2.3 million now, and a growth rate of 3.6% over the past 12 months, which is actually the highest in the country. It's continuing to thrive. So additionally, current listings stand at about 12,000 compared to 25,000 pre-2020, indicating a severe undersupply still. We believe that house prices in Perth will continue to perform strongly in 2024 and 2025, with growth of 13 to 15% before returning to historical growth rates thereafter. Also, just important actually just to touch on some of the reasons for those low supply rates is because people are unwilling to transact in a similar market where that's still quite buoyant, because it's all well and good to sell your property for a high value, but you still actually need to go out and purchase another property in that same particular market in the same conditions. And so that's somewhat causing people and vendors to negate the need to sell at this particular point in time, because it's going to take time, and it's also going to be quite tricky for them to be purchasing another asset in that same particular market unless there's favourable settlement conditions to allow enough time for them to go out and source, buy, and settle on those properties. So that's common, in particular across those key markets that have shown the strongest growth in the last 12 months, Perth, Adelaide, and Brisbane. So from our point of view, we believe Perth will continue to perform strongly in the next 12 to 18 months, and strong rates around 13 to 15% before it returns to historical growth rates thereafter. So still a little bit of gas left in that particular market, but it is tricky purchasing conditions. Canberra, house prices expected to enter early stages of recovery in 2024, 2025. The nation's capital has struggled to establish a robust recovery, and likely to follow a slow growth trajectory still. So current data shows that the number of listings has stabilised at 4,000. The economy remains heavily dependent on government employment at a time when AI and digitisation could potentially weaken the strength of the labour market. We believe that house price in Canberra will increase by about 0 to 4%, 2024 and 2025, followed by growth of about 5 to 6% thereafter. Hobart, small population, 250,000, negative growth rate over the past 12 months reflects a weak overall economic conditions and housing demand. Although the number of listings is decreasing, demand remains insufficient to drive significant price increases. Recent trends suggest that the Hobart market is entering a recovery phase, but predicted growth rates between 0 and 2%, and then about 3% circa thereafter. Hobart has come off a significant run, generally probably given the low entry rate in that particular market. However, there's some concerns around sort of the population and the makeup and the dynamic of the population in that particular market. And in Tasmania, where you've got a lot of millennials completing their schooling or university, moving to the mainland for work opportunities, and you're getting a lot of baby boomers moving into that particular state for retirement. So that it's representing a bit of a weaker economy at this particular point in time. Darwin, we don't invest in the Darwin market. It's too small for us. However, it's got a low growth rate from a population perspective. It's quite a transient population, and it has minimal economic drivers. From our perspective, it has been performing not too well at this particular point in time. And from what Kevin's suggesting is that we don't believe it's going to see any significant growth. Investors are seeing value from a yield perspective, has some of the strongest yields, or does have the strongest yields across the country from a housing perspective. So that is certainly an option if you're looking for focusing just on yields. There's potentially some options in that particular market that you could consider. Separately, so regional house and unit prices are expected to experience moderate growth in 2024 and 2025 beyond, though the outlook varies state by state due to differing demand and supply factors influencing the market. Many people who move to regional towns are returning to larger cities due to weaker labour markets and increased in-office requirements mandated by many of the bigger and smaller firms. This will weaken housing demand and dampen the price growth potentially in regional areas that are far from major capital cities. We believe, however, regional areas, especially those close to metropolitan centres, such as your Ballarats and Geelongs, Wollongong, Sunshine Coast, Toowoomba, Ipswich, for instance, in Queensland, remain attractive to home buyers who have been priced out of city markets but still want proximity to urban amenities. And as a result, these regions are likely to continue seeing strong demand from these segments of the population. So guys, that's a bit of an around the grounds from a property perspective, what's happening. Again, as I touched on, we'll share this with everyone afterwards, so you can take a bit of a deeper dive into that particular information. But just quickly, and I know I'm probably running out of time, but just on our digital platform, so we understand that purchasing property from afar can feel daunting. The process can be seen as archaic and multiple stakeholders and a lot of paperwork. So along with our incredible team, the process is managed on a digital platform, providing education, building trust, and most importantly, a streamlined process. So it's been crafted in-house from our subject matter experts. We have a team of engineers who have been building this. It's AI mobile optimized and allows you to track every aspect of the property purchasing and owning experience. And as you can see on this next particular slide, the product allows you to track that journey from a game plan perspective. So bespoke game plans, we're creating personalized plans that help you achieve your desired property outcomes, moving through to data-driven recommendations. So platform will pair the right location to the output of your game plan, providing tailored recommendations for regions, suburbs, and also properties based on your preferences and goals. It's an end-to-end service. So Milk Chocolate, we handle that whole aspect of the property buying journey, from sourcing and appraising properties to managing negotiations and settlement. And of course, ongoing property management. So once the purchase is complete, if you're not moving straight in, the platform continues to support you with property management, including portfolio management, maintenance plans, and renovation projects. So guys, as you can see, if you need help, obviously we can do this with you. Our details will be left behind, and you can obviously get in touch with us if you have any questions or you'd like to find out more about how we go about it. But I'm going to wrap up now because I know the guys are eagerly keen to get into their work as well. And I'm sure there might be some questions which we can answer when the team are ready.
Awesome. Thanks, Richie. There was very comprehensive information on what's happening in the market, and also, yeah, look forward to seeing the experience on your digital platform with a seamless experience. Yeah, so guys, so we've heard a lot of insights from Richie on the property market, and I'm now going to take you through to actually make your dream bring your dream to real, which is buying a property through finance, which is the mortgage side. So I'm just going to share my screen and then we'll go through. And before I kick off, just to give a bit of an intro about myself. So yeah, so I've been in this Australian home loan industry just for over a decade, selling home loans, building home loans, managing home loans, and distributing and operating home loans across major international banks, and some of the largest aggregators in Australia. So I'm actually a new expat myself. Moved from Sydney to Singapore about 6 months ago. So going through this a learning curve, living abroad as an Aussie. So in terms of who we are, so Odin Mortgage, so we're essentially the mortgage broking service business where we help Aussie expats and overseas investors looking to buy properties in Australia or manage their existing home loans for an optimization opportunity. And in terms of where we how we come in, where we differentiate, so I guess there are three main levers. So Odin, we only specialize in expats and overseas lending. So that means that we specialize in the foreign income policy across the banks and lenders, and also we're pretty good at translating our expat and overseas resident circumstances into the banks and lenders language, so that it increases the chance of getting a home loan approved. Where in fact we've been helping a lot of clients who have spoken to their own banks and lenders in Australia and gone through the frustrating experience getting no as a response. So we're here to help you, guide you through that niche sort of policies and product offerings and restrictions. And also we work across not only Australian banks and lenders, but also some of the international banks here in Singapore and Hong Kong and Asian market, where they actually offer lending against Australian properties in different currencies. So Odin will be able to provide you with the broader sort of the options compared to the onshore Australian brokers. And then lastly, you can see on the slide that there's a call out of the one team. So our service, it actually lasts throughout your property life cycle. So not only we help you get a finance approved to support your purchase and then help you through the settlement, and even beyond the settlement, we monitor your home loan product to make sure that your product is one of the best in the market. And if there's any updates or opportunity for us to save or optimize, our concierge team will continue to support you beyond the settlement until you either sell the property or close the loan. And I won't go too deep into the Australian what's happening in the property market because we all heard about the exciting dynamics that's happening in the Australian market. But I just wanted to touch base that I'll unpack a little bit on what Richie just has told us about the return and also the mortgage. So as of last month, that we're now seeing that over $2 trillion of the mortgages that are outstanding, and it's actually growing, driven by a lot of investors coming back, and also a lot of the overseas investors, especially in Singapore. We actually observed that our clients are attracted to Australian properties for two reasons. One is that it's generating a pretty steady return. So you can see that 7% annual growth across both capital cities and regional areas, even though it's been mainly driven by Perth, Adelaide, and Brisbane. That the assets are delivering that consistent return. It's quite unique. And also the ability to enter the market, unlike some property markets or regulations in the Asian territories where you need a large amount of deposits, or whether you're limited by the number of properties that you own, where Australia is a great alternative to a lot of our foreign investors who are coming to us. And what's happening in the home loan market? So again, Rich here has touched base on that the lending across the owner occupiers and investors are growing, driven by the investors recently. So this chart that you're seeing on the screen, it just outlines the trend of the variable rate and fixed rate home loans. So you can see that the interest rates are somewhere between 6.5 or slightly up, and it's remained quite steady as the Reserve Bank of Australia has remained their cash rate at 4.35% for almost the last 12 months. And what that allowed the market to do is that there are two things that has been happening recently. So one is that even though the rates are relatively high compared to the history, the stability that the market has been able to deliver started attracting a lot of investors coming back. So we're seeing more and more domestic and foreign investors that are coming to us now that they've been holding, watching the market, but they're actually pulling triggers to get in. And also we're observing the fixed rate interest rate in the context of the investment home loan is actually now outpacing the growth of the variable rate. So what that means is that unlike say 18, 24 months ago, where the fixed rate was extremely low compared to the variable rate, now variable rate and the fixed rate are almost on par, where it sort of creates the sentiments in the market that the rates might have peaked now. So it's now a matter of when the bank would actually start dropping interest rates. And as Rich touched base, we're actually now observing not only across the major banks, but also some non-major banks in Australia have started dropping the interest rates out of cycle, mainly on the fixed rate products, and also across the variable rate products. We're observing more and more banks and lenders offering more discounts to attract the buyers, which is very timely as the spring season kicked off in Australia, where the competition amongst the buyers, more demand from the buyers, it actually created competition amongst the banks to attract the buyers to take out a home loan with them. So if you want to know about the current interest rate, what you may be eligible for, come and talk to us. And also what this chart tells us is that if you have a property in Australia, and if you have a mortgage, and if your current interest rate is above any of these numbers, it means that there's an opportunity for you to potentially save the cash outflows. So I wanted to touch base on what are some of the key considerations when buying a property in Australia as an expat or as an overseas investor in the context of getting a home loan. So unless you have, I guess, the liquid assets or cash available to make a purchase without getting a mortgage, most people in general do lean on the mortgage products to support their property buying plan. where we do get a lot of questions from expat clients and also overseas investors around what are the key difference between buying while living abroad or outside Australia versus buying while you're in Australia. So I wanted to take you through some key considerations. So when it comes to buying a property, the purchase price is determined by two drivers. So one is the deposit position, which could be your cash assets or liquid assets, as well as some equity that you may have in the existing property if you already own a property. And the second lever, it's a loan, which is mainly driven by the borrowing power. So just to call out, this is general information. So of course has not taken into account any of the personal circumstances. And it's subject to credit assessment and review of your information. And when it comes to buying a property as an expat, banks and lenders generally do offer maximum lending up to 80% of the property value, where by exception, a lot of Australian borrowers, especially for a first-home buyer or you're buying a family home, that you may be able to get access to up to 90% lending, which means that the amount of deposit that you need to contribute will be lower. But in the context of the expat or overseas investors, that generally minimum 20% of the purchase value will be required if you were to go ahead with Australian lenders. And in the context of some Asian territories in the markets where you may have access to other international banks, that they have international banks do have, I guess, more restricted lending criteria where typically you would need up to 30 to 40% of the purchase value as a down payment or as a deposit. And then the other cost that you need to take into account for your deposit is stamp duty, government charges, and the legal costs, where typically if you hold an Australian residency, either as an Australian citizen or Australian permanent resident, that typically the sum up costs will be around 5% of the purchase value. However, if you're a foreign investor that do not hold Australian residency, that typically you need to take into account the one-off costs for the government grant through FIRB or Foreign Investment Review Board, and also additional stamp duty and the surcharges that could go up to as high as 12 to 13% of the purchase value. Now, in context of the loan, so I just there are a lot of considerations that goes into when it comes to determining your borrowing power. It's mainly driven by income and expenses. So as an expat, in general, we do see a lot of expat clients have relatively high earning powers compared to as if you're working and living in Australia. So what that means is that the high gross income and also any allowances that you may get as an expat, that could actually take into account as a positive impact for your borrowing power. And also, if you're in the country where the income tax rate is lower than Australia, where we do know that most countries in the Asian market do offer a more competitive lower income tax rate, that also could actually take into account as a positive impact for your borrowing power. However, there are some catches that you need to consider which could potentially drag down your the maximum loan amount that you may be eligible for. So one typical thing is that the higher living expense items such as rental, if you're renting in the country that you reside, and also any private or international school fees if you have a family and the children and that are going to those schools, that these are the typical expense line items that you would have not incurred as if you're living in Australia. So these could actually increase your expense profile, therefore negatively impact your borrowing power. And then lastly, Australian lenders in general, they do apply restrictions to foreign currency income. So what that means is that if you're earning $100 in Singaporean dollars as an example, instead of taking your entire $100 income into the calculation of the borrowing power, most banks and lenders would actually apply 20 to 40% haircut to your income. So that means that instead of taking the $100 into account for your loan amount, you'll be assessed based on $60 or $80 to see if you'll be able to service the particular loan amount, which of course that it negatively impacts the borrowing power. But fortunately, over the last few months, the team at Odin, we've been working closely with a lot of Australian banks and lenders to communicate the challenges and the circumstances of the expat communities, where we're actually now seeing a few lenders are coming to the market with more relaxed policy when it comes to foreign currency income, and also recognizing the foreign income tax rate, as well as the reducing their restrictions or softening their restrictions to the foreign currency income, which we've been able to help a lot of expat clients who did not get the favorable answers from the banks last year, where the same bank we're actually getting a positive response through our specialists. So if you are questioning any numbers in terms of how much you think that you'll be able to borrow based on your local currency income, come and talk to us, and we have access to more than 20 plus lenders across Australia and overseas. So you could use us as a platform to compare your information and get the indicative information, so that it helps you shape your boundaries and set the range as you get ready to start looking to property market. So that's about Odin Mortgage. Now we talked to the property market, and also we talked about financing to support your purchase plan. And lastly, I'd like to hand over to my colleague Pao to take you through tax implications and how you could actually manage the costs and money as you manage through your property. Over to you, Pao.
All right. Thank you, Stephen. So maybe let me give you guys a quick intro about myself so you understand my background and where am I coming from. I'm leading the tax team at Odin, and why the main reason why we combine mortgage and tax as one business at Odin is really to help all the Australian expats to handle their tax and finance remotely and easily as an expat, as a non-resident tax purpose. I came back from Sydney to Hong Kong. I'm based most of my time in Hong Kong. I came back for around a decade as well. So since then, I've been looking after Aussies all around the world to handle the tax in Australia as a non-resident for tax purpose. I'm happy to be in Singapore this week. So if any one of you want to have a check and meet up to discuss your personal tax, feel free to reach out to us later. But today I'm gonna quickly go through around what does it mean when you are in non-resident for tax purpose? What are the factors or issues you want to look into, and how Odin can assist you in this area? So our services cover from the basic, helping you to complete the tax return, make sure you are doing it right. So you are, I believe most of the people here are non-resident for tax purpose because you are living your life overseas or Australia. If you have been doing this for a certain period of time, then it's quite certain to say you can be seen as a non-resident for tax purpose. And your only obligation to Australia would then be any income that you receive from Australia. So getting your residency right and doing return correctly is important. One, to protect your overseas income not being taxable in Australia, and stay compliant. I think that's very important. A lot of people that I've met is since they left, they are not really paying too much attention to their tax. There are many overdue years they haven't looked back into, so it's important to catch up on those. And then the other part of our business is to give you the right advice. If you're thinking of doing different types of investments back in Australia, what is the right structure? What is the timing, the vehicle, and how to think of all the tax and the costs involved in buying and holding, say, properties in Australia. So we will jump in from day one to assist you from both mortgage and tax to make sure you understand throughout the whole process. So quickly, if you are looking to buy a property, today our topic is around all properties, so I want to just focus on here as well. If you're looking to buy a property in Australia, invest in properties in Australia, I think it's important for you to understand what is the cost of the investment and how to run it, and what is the end game, which is when you sell the property, what is the capital gains that you need to look at. And stay compliant, because there are a lot of benefits if you understand fully what does it mean. One of the things I'm going to talk about later is about negative gearing. So it is still available for expats, so we can utilize the losses to offset any of the future income. And it's important to also look after your history. You haven't been really paying attention to your tax in Australia. Why is it important? Because one, like I mentioned before, you want to make sure that you understand that you have been a non-resident and working overseas. Whatever you're making in Hong Kong, Singapore, Korea, in any part of the world, has nothing to do with Australia. You don't need to report the income to the tax office. It should only be anything you might get in Australia. And to avoid the penalty, if you are late for submission, there could be a penalty up to 1,500 per year. So I've done people with 20 years of overdue tax returns. If ATO really look into their file, it could stack up to 30K, 40K of taxes and penalties. So you want to look into it before ATO look up your file and make sure you catch up on those as well. And if you're thinking you won't be coming back to Australia, this could be a final. Maybe we can help you to submit a final tax return as well, so you can wrap up everything you might have with the Australian tax office, so you don't need to worry about what happened in the future. But always you can come back and say, no, my plan has changed. I now start to have income from Australia because I just bought a property in Australia. We can always go back and tell them situation, circumstances has changed. Now I need to submit a return with the tax office. As a non-resident, you would only need to report the income that you receive in Australia. If you're still working for an Australian company, I think most of people would not. They're working overseas for an Australian company. But if you do, potentially you might still need to report that income. Any income from a property, the rental income, the bank interest, the dividends, the capital gains will need to be reported in the tax return. And if you still have a student loan, the HACS in Australia, you also need to report to the tax office and start making repayments on the HACS debts. And what the ATO will look at is how much are you making overseas. This is purely for the calculation of the repayment. You don't need to worry about, oh, do I need to pay tax on this income as well? The answer is no. And the bracket here, we have a more friendly bracket this year. The rate has dropped to 30% and the threshold has been widened. So at the end of the day, we only need to look at what bracket are you in. Do you have any income in Australia? If you don't, then you probably will be in a loss position, so we can accumulate those losses. When it comes to property, understanding the first step about cost of buying the property is important. So I always break it down into a few things. One is the stamp duty, the legal fee. These are like quite mandatory. And the FRB, and this is only applied to if you are not an Australian passport holder or not a PR, you're purely foreign investor. You would need to pay for an application fee with the FRB, which is the Foreign Investor Review Board, to check on your qualification if you are able to buy a property in Australia. And also the other one, which is a surcharge. Different states has different rules on surcharge. And this only applies to, again, foreigners who want to buy in Australia. But I want to point out one thing, which is for PRs living overseas. If you're looking to buy in Sydney, New South Wales, be mindful that the surcharge may still apply on you because the way New South Wales look into PR is if you're generally living overseas, they would like to treat you like a foreign investor. So it's important for you to understand what is the cost if you're looking to buy a property in Australia. And some work around that maybe you can look into as well, and this work pretty well with a mortgage is if you are married to a non-Australian partner, potentially there could be ways to help you avoid one, the stamp duty surcharge and still get finance for the purchase of the property. There are some banks out there who can accept a non-Australian partner on the mortgage, but doesn't require him or her to be on the title of the purchase. So we can avoid the stamp duty surcharge, but at the same time still get finance for the bank. And then the next step is once you settle the property, you need to maintain the properties. And native gearing still applies, so you can look into whether you need to pay tax or you can accumulate some of the losses. And at the end of the day, if you hold a property for 10 years, what would be the capital gains you need to look at? So in terms of running the properties, the rule of thumb is every dollar you spend on the property is tax deductible as long as you can show that the expenses is related to maintaining the property for rental. So here I have covered most common expenses they can claim in a tax return, including the biggest item, which is the interest on the mortgage. So ideally, if you're having a mortgage at 60, 70, 80% LVR with the bank, I'm quite certain that you will be in a loss-making positions. We call in a negative gearing positions, which means your expenses, including all the items here, will be able to deduct the rent that you're getting from the property, and you will see a loss on the property. And for those losses, you will be able to carry them all forward to future. So these losses wouldn't expire. It's indefinite. So in what occasion you can use them, either when you return to Australia, start working, or when the property becomes positive, or when you sell the property, have a capital gains. You can then utilize these whatever 10,000, 100,000 losses that you have accumulated and carry forward to offset any of this income that comes in first. And the last part about selling the property when it comes to the capital gains. Again, all the expenses you pay on purchasing and selling the property is deductible, including Richie's fee as a buy agent that can be also deductible when we calculate the capital gains. The stamp duty or the surcharge, and the legal fee, agent fee, all those will be a cost base. It will be added into the calculations. And again, those losses that you accumulate from the property will be able to assist you to further reduce the capital gains. So at the end, we just need to look at the calculations. What is the sales price minus the cost that you incur in buying and selling the property, and then minus the losses you have accumulated. If you're still having a positive income, then we look at the bracket I showed you before, which level, which bracket would you be on, what tax you need to pay. It's important to note that as a non-resident for tax purpose, a few things have been removed from us as a non-residents. So first one is about the 50% discount on capital gains tax. Rule change back in 2012, the government has removed this rule from us as a non-residents. So meaning if you buy any property after 2012 as a non-resident and still hold it as a non-resident for tax purpose, you would no longer enjoy the 50% discount. So if you make 100K of profit, that 100K will be taxable at the marginal tax rate. And another rule that a lot of people don't realize until they really sign a contract and the solicitor come back talking about these rules is if you are selling a property for more than 750 Australian, you would need to enter into this reporting system, which is this is ATO want to somehow take some money out from the settlement first to be seen as your potential capital gains you need to pay on the property. And they want to take that money at the settlement. And what you can do is you can either do a variation, tell them, no, I don't need to pay 12.5, I need to pay 2.5%. And this require your tax return to be done in time and also a calculation percent to the tax office. So it's important to note that if you're thinking of selling, you probably want to look into this first. If you're expecting the money to come to you sooner than later, that could be a delay of payment if you don't really look into it too deep. So yeah, that would be what I'm going to cover today. Again, if you want to talk into your personal levels about how to help you in your personal level, feel free to come in. And there are ways and strategies we can help if you are in the opposite, making a positive income on the property, which usually is by using super to help you reduce tax or drawing equity from your property because likely you have a huge equity in the properties. You can use the money to potentially buy another investment property. The losses from the second property can be used to offset the rental, the positive income from the first property. So that's another way for you to minimize your tax in Australia. I'll pass on back to Stephen to maybe we can go into some of the Q&As.
Awesome, thanks, pal. I'll just stop sharing the screen so we can all see each other. Yeah, thanks so much, guys. So I know we only got a minute, and there are quite a few questions that have come through. So we'll just pick top three to address them, and then for those that we are not able to answer, we'll answer them separately after the webinar. So the first question that we have is, I'll probably pass this on to you, Richie. So when it comes to buying a property, a lot of clients do ask about what type of properties. What are the pros and cons between buying a house versus a unit?
Yeah, we get asked this question quite a bit as well. Milk Chocolate has an ethos to have a preference to purchase established houses. in established suburbs as close as possible to the major CBD as possible. If we can't afford to do that, we'll look at those sub-regional markets. Alternatively, we would look at apartments. I suppose a couple of the key differences is land appreciates in value generally if you purchase in the right areas, dwellings depreciate in value. We like purchasing properties that come with options, what we call optionality. So generally, if you're purchasing a house on land, it's going to have the ability to either one, cosmetically improve, two, structurally extend and add bedrooms or floor space, three, subdivide, four, granny flat. So it just gives you those options for now or in the future. So you've got plenty of levers to pull if your circumstances may happen to change. You've got the ability to execute on one of those. That's generally the key differences for us. And historically, we know that houses have appreciated in value greater than what apartments have historically. So they're the key things for us.
Yeah, awesome. No, thanks so much.
Okay.
I know we're over, and Pal, I'll probably ask you the question, and then we'll take the rest of the questions offline. So you've explained the difference between the tax residents and the non-residents. So what's the so the question is, what's the required time frame for a non-resident to be in Australia for them to be considered to be a tax resident?
I'll answer this one with Alon and also another question about a potential change to the rules. So for now, we are looking at one of the rules that we're looking in terms of the time frame is 6 months, 183 days. So if you spend more than 183 days in Australia, you are likely to be seen as a resident for tax purpose. And we have a potential rule change, and I'm not sure a lot of people have heard about it, about a 45 days rule change. So the government first brought it up in 2020, and it has been 4 years now, 4.5. The latest update on this is initially I was expecting this might be pushed out in the May budget this year, but it didn't happen. So we have been over a year since last consultation from the government. We have no update since. I'm expecting this will be delayed for maybe at least 1 to 2 years. We have an election coming in next year, so I don't think the government wants to look into it at this point of time. Likely to be after the election, and maybe even could be another 1 to 2 years of delay. Most time the government will bring in new rule change in the May budget. So if we are not seeing anything change in the next budget, May 2025, it's quite safe to assume that this might happen in May 2026 or even longer, May 2027. But I do think this will be passed at the end of the day, but probably not on 45 days rule, maybe up to 90 days, 3 months. So what it might happen is, yes, eventually we may be looking at, instead of 6 months, we're only looking at 3 months. If you spend 3 months in Australia and with other requirements, you are likely to be seen as a resident in Australia.
Cool, awesome. Thanks so much, Pal. So guys, we're 4 minutes over. So for any unanswered questions, we'll take them offline and then answer them separately after this webinar. And also we'll send you the copy of the slide decks. So let's wrap up. So today we had Richie from Milk Chocolate Property. So if you're interested in how learning, sourcing, negotiating, finding and buying the right property in Australia, reach out to Richie. If you don't know, understand your tax implications in Australia for your property, come and talk to Pal. And lastly, for any borrowing options or want to know about the interest rate options, come and talk to me, Stephen Lee in Singapore. Thanks so much, everyone. We hope to see you again next time. Take care.
All right, see you guys.
Thanks, guys. Thanks for your time.
Bye.
Thanks, Pal. Thanks, Steve.